Since 1913, the US dollar has lost over 96% of its value. The money in your pocket is worth a fraction of what it used to be. Coincidence, or a result of the Fed's policies? Tonight, we dive into the Federal Reserve's power over the US economy, inflation, interest rates, and quantitative easing. We'll explain it all in simple terms. The Fed's decisions affect everything from mortgages to avocado toast. So what is the Federal Reserve, or the Fed as the cool kids call it? In a nutshell, it's America's central bank. Imagine it as the referee of the US economy, tasked with keeping things fair and preventing the whole game from descending into chaos. Its main job is to control monetary policy, which basically means managing the supply of money and credit in the economy. The Fed does this through a few key tools, which we'll get into later. But the goal is to keep inflation in check, because nobody wants to pay $20 for a gallon of milk, and promote economic growth so we can all afford said milk, even with inflation. But like any referee with that much power, the Fed is no stranger to controversy. Some people accuse it of being a puppet master, manipulating markets to benefit the wealthy and leaving everyday Americans out in the cold. And it's true, the Fed doesn't always get it right. Its policies can have unintended consequences, like creating asset bubbles or exacerbating income inequality. And let's not forget the whole lack of transparency thing. The Fed operates largely behind closed doors, which makes some folks understandably nervous. After all, when an unelected group of people has this much sway over our economy, shouldn't we at least know what they're doing and why? Section 4. Interest rates, QE, and the unintended consequences. The Fed adjusts interest rates like a volume knob for the economy. Lower rates make borrowing cheaper, boosting investments, but too low, and you get inflation. Quantitative easing, or QE, injects trillions into the system. Critics say it inflates asset bubbles, benefiting the wealthy. Section 5. The 2008 crisis, the Fed's defining moment. Remember the 2008 financial crisis? Yeah, not exactly the Fed's finest hour, but it was a defining moment for the institution. As the housing bubble burst and the economy went into freefall, the Fed stepped in with unprecedented measures, slashing interest rates to near zero and unleashing QE on a massive scale. These actions are credited with preventing a full-blown depression, but they also raised concerns about moral hazard, bailing out the very institutions that caused the crisis, and the long-term consequences of such extraordinary monetary policies. Section 6. Friend or foe, the Fed's double-edged sword. So, is the Federal Reserve a friend or foe? The truth is, it's probably a bit of both. The Fed plays a crucial role in stabilizing the economy and preventing financial meltdowns, but its actions can also be opaque, controversial, and prone to unintended consequences. It's a powerful institution with a delicate balancing act, and its decisions affect all of us. That's why it's so important to understand what the Fed does and engage in informed debate about its policies. Because at the end of the day, the Fed's decisions shape the economic landscape we all live in. Section 7, now you decide, is the Fed a force for good? So what do you think? Is the Fed doing a good job? Are its policies helping or hurting the economy? Head down to the comments section and let us know. And while you're at it, check out our website for more in-depth analysis of the Fed, the economy, and other things that keep you up at night. Don't worry, we have cat videos too.